Hello, it's Julie with Fairway here. I'm a local loan officer, and today we're going to be talking about equity. I get asked all the time, what even is equity? Why do I care about it? People say they have so much in equity, equity's this, equity's that, and half the time people don't even know what that word means. So today we're going to talk about it. Home equity is basically the difference between what you owe on your home, the mortgage balance on your home, and the market value of your home. So if you own a home that is worth $350,000 on the market and you owe on your mortgage $200,000, it means you have $150,000 in equity on your home. It means that your home value has appreciated, your mortgage balance has gone down, and you have earned equity, which is essentially just adding to your overall net worth. So it's what makes homeownership the quality investment that it is. Home values appreciate about 5% per year. So if you think about it in a way that every month that you make a mortgage payment, that balance on your mortgage is going down. Meanwhile, simultaneously, the value of your home is going up, then your net worth is just increasing over time. It's similar to if you were to buy a stock for $10 a share, and then the next day, the value of that stock was $15, you would have made a good investment. Your net worth would have grown. So it's a little bit confusing, but when you think about it in those terms, it makes it a little bit easier. It's estimated that there's over $11 trillion in untapped equity for homeowners in the United States. So that means that altogether, homeowners in the United States are sitting on about $11 trillion in value, non-liquid assets that they're not doing anything with. And that's okay. You don't have to liquidate your equity. Just sitting on it, like I said, it's an investment over time. Your net worth is growing over time. But what makes equity important and how it can affect your life is that if you ever had any reason to liquidate that equity, it's there for you. So if you had a family emergency come up, if you had to relocate, if any multitude of reasons that you would need to cash out, then you can do so. It's basically assets that are yours, that you own, that you can utilize if necessary, or you can let them just keep growing over time. And when the time comes in the future, if that time comes, you can cash out on that equity and have those as liquid funds, or you can pass them on to the next generation in your family. It's a pretty big deal, and that's why homeownership is one of the most sound investments that one can make, because on the stock market, we have no way of knowing, company stocks are going to go up and down. What's the market going to do? And the housing market is the most stable market that you can invest in, because historically, appreciation is expected. We haven't seen, in our area at least, home values go down since the housing crisis in 07 and 08. And I could talk all about that. Go watch The Big Short. It's very, very, very fascinating. But because of the laws and way things are now with mortgage lending in this country, it's just not going to happen again. We have too many safeguards in place. And because of that, housing values have gone up considerably, especially in our area. So anyway, on and on and on. That's what equity is, and that's what it means to you. The ways that you can tap or liquidate your equity would be a home equity line of credit, which is basically where you go to a lender and say, hey, I've got $150,000 of equity in my home. I need some money. And they'll basically give you a line of credit for some of that equity using your home as collateral. And then you can charge it like a credit card and pay it off, and charge it and pay it off. The interest rates aren't great, so it's not necessarily the best idea, but it's there if you need it. Another one would be a home equity loan, which is similar, except you take a fixed amount of money out and you have a steady payment that you're making to pay it back, and the interest rates can be a bit lower. The other option would be a cash out refinance. So if you bought your home many, many years ago, or even not that long ago, and your home value has gone up, you could refinance the home for its current value and just get a lump sum in cash liquidated right back to you. That's an option. A lot of people use the equity in their homes to consolidate high interest debt. So for instance, if you have student loan debt that averages 6% interest, which is a lot, you could refinance those student loans or credit card debt or whatever the case may be into your home loan at the low interest rate that you would get for your mortgage, 3 or 4%. So that can save you quite a bit of money over time. Anyway, I hope this has been helpful. If you guys have any questions at all, please don't hesitate to send me a message, leave a comment, call, text me, whatever. I'm more than happy to help, and I will talk to you soon.